The European Central Bank's second major liquidity injection tops forecasts. Commodities back on the move as most indices close above psychological barriers. Can this accelerated uptrend continue? I'm Taylor Schruntz, and the morning call starts right now.
Good morning, I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Stephanie Link, Director of Research at The Street, and together we bring you the morning call.
So I think it was last week you were called to go to Fox to talk about Dow 13,000, and I think people were asking me about S&P 1370, and it took a week to finally break down the barrier. So yesterday we closed above it, everyone's all excited, and I don't think that's the reason to get excited. I know you talk about the positives in the economy, and I talk about the technical trend. To me, that's what makes me very excited. You know, what right now are you looking at as far as short-term, intermediate term? Like, what's your focus?
I just want to make sure that the economic momentum that we've seen in the U.S. so far continues. And we get a lot of data this week, particularly tomorrow. You know, we're going to get more jobs numbers, we're going to get manufacturing data. So there's a lot still yet, to see if we can continue this momentum. And then, of course, we've got to keep all eyes on Europe, but China. China, to me, is the wild card. We have to see if actually they continue this easing, and I think if they do, you've got two really big countries, and regions that could give some significant momentum, going forward.
Now, what do you think about the ECB yesterday? Everyone was saying maybe 300 to 400 billion euros. It came in at like 529. To me, I don't think it was that big of a deal. What's your take on that?
I think it was in line with expectations. And so, but it's good, right? I mean, they are slowly building liquidity into their system. And really, our banks, this is like where we were a couple of years ago in terms of our banking system. So now they're getting the liquidity they need. They're getting out of crisis mode. And that is very important.
If someone would give me a few $1 million or 1% for the next 3 years, I would take as much of it as possible because I know I could do a lot better with it.
Right.
So as far as everything that's out there, all these headwinds, the charts have just been unbelievable no matter what anyone wants to say. If you look here at the trend of the S&P, you will see, we've had this gradual trend since October 4th. You have a higher low. If you trend it all the way up, we haven't even gotten close to testing it. On December 20th, we broke this little descending channel, which I drew back then. This was actually when they did their first ECB. That's when QE3, I think, started. And then you've had this accelerated uptrend, this uptrend that's been trailing and following this 10-day moving average. So until we get a decisive close below this 10-day or below this uptrend, I think you have to stay with it and stop fighting it, because I think like the cool trade right now is everyone's trying to get this 2 to 5% correction. That hasn't happened yet, but we'll see it when it does.
Well, yeah, we'll see if they actually, in fact, buy when they say they want to buy. But it tends to happen that when you have a correction, people say, oh, wait a minute, maybe we will wait a little bit. So we'll see the conviction levels. But can we look at maybe the longer term chart for the S&P?
And when we look at the longer term chart, it still amazes me how bearish people are and how people are so battered from the market, because the trend here longer term still looks good. If you look here at the chart, you will see, let's go to the monthly chart. Okay, if you look here at the monthly chart, which you can take a nice glance at, this was one of the highs. Okay, this was back, a few years back. You had your double top. So this was a very bearish pattern before we broke support back in 2007. But if you look here at this outside day, I talk about outside days when you switch gears, days to to change your thinking. This was your low, and this was in 2009. You had a move and you made a high here. Then you had a higher low. Okay, then this is last year's 1370. Then we pulled back, tested this trend, and held. Okay, now we're up at 1370, or 1370 and change. Everyone's saying this could be another double top, so the course is getting loud for that. But even if this proved to be resistance and we pulled back to test this trend, we still are in an uptrend since 2009. We still have been trending higher, where there's been a lot of money to be made in stocks as a stock picker as well as a stock trader.
Well, that's exactly right. That's what's different this year, is that this year you pick stocks, you do your homework, and hopefully you're right? I mean, you can be rewarded, though. That is the point. Whereas last year, stocks were almost 100% correlated to the market. So very, very challenging to outperform in that kind of environment. So for us, I mean, we're kind of excited that there's a lot to choose from. Valuations are not stretched by any means, even though we've had such a nice move in the market.
So with that said, let's go into Sector Spotlight. Let's talk about some of the positions you've been managing, because she manages multiples and she has to take advantage of pullbacks, take advantage of breakouts. And I think the first stock you wanted to talk about was Stanley Works.
Yeah, Stanley Black & Decker. So yeah, but you know what? It's easy to because everyone remembers Stanley Works and Black & Decker. Well, actually, Stanley Works bought Black & Decker a couple of years ago. So, and that's actually one of the reasons we like this idea. They've made multiple acquisitions over the last couple of years. They're very synergistic. This is what this company does. They're very good at M&A, right? So they're going to extract a lot of revenue synergies and cost synergies, and that gives you the cushion to wait for housing. But the real reason you want to own this longer term is because they've got exposure to Home Depot and Lowe's, right? The do-it-yourself market. And if you believe housing is in the recovery, which we do, this stock goes.
And I do think that housing is getting a little bit better. I actually just closed and got my mortgage on a nice house. My wife's very happy. But with that said, you look at the chart here and you'll see that it's been technically acting great. You know, since it put it in its low, it methodically went to resistance, then broke above, and now it's consolidating again, and it looks like it's extending. You want to take a bit of a longer term view. You know, it's coming into some major resistance here, so it might take a little bit of time, but ultimately it does seem like it's going to take out this resistance, and it has a road longer term to probably 90 to 100. But short term here, I think traders could get a little cash flow if it could finally break above yesterday's high and extend a little bit.
Yeah, it's certainly a name, you know, one of the many that we're playing on the housing theme. And as you say, you know, you feel better about housing, we do as well, in terms of, you know, all the data points that we've been seeing, really. New homes, existing homes, pending sales. You know, those are they're certainly bouncing along the bottom, getting a little bit better. So
another stock that you're currently managing is Eaton, ETN. What's your thoughts there?
Yeah, you know, and so this is kind of timely because just yesterday, Cooper, which is one of its main competitors in the U.S., they actually raised their guidance to the high end of the range for their quarter, both revenues and earnings, citing better electrical demand. And Eaton is actually its main competitor. Actually, it does it a little bit better. So this is a company that's a diversified industrial, you know, and we actually think that they have exposure to some of the strongest trends: auto, truck, aerospace. We like all those.
And I think you spoke about this even before the new year, so that means, you know, you have some nice gains. So
yes, we do. But we were buying. We were adding to it yesterday based on what Cooper is saying. I think the numbers are way too low. And this company, Eaton, raised numbers last week because of an acquisition that they did. So this is one that I think is still very high quality, trading at 9 times 2013 earnings.
So now let me see. Let's look at the chart, see if there's a trade here. So if you look at the chart, you know what? This was the first time it broke this little downtrend. It cleared its resistance, gave you a nice move, pulled back. You know, holding the moving average. It's getting a little sloppy here, or not sloppy, just, you know, it hasn't extended again because traders love extensions. But I'd say if it could finally clear this area right here, you know, what is this, around 52.75, you could get a nice breakout move for traders. If you're an investor, I think you stay this methodical course. And if you talk about a different type of scenario, let's talk about Broadcom that isn't near the highs. It's been more of a value play, and it's starting to play some catch up. What is, you know, Broadcom?
It's really, you know, if you like the smartphone industry, they do about 50% of their revenues tied to smartphone products, right? And their biggest customer is Apple. So this is an Apple play, but it's also a play on other gaining traction, gaining market share at their other customers as well. They have the best technology out there.
And I used to love to trade this stock back in the day. And back in the day, that's a phrase that everyone loves. But the chart looks good. It had a big move. If you look here technically, you know, we've had some trades from time to time. This, I think, is where you were buying it down here. Congratulations. That was a nice little spot. That's when it cleared this lower end. And then right now, it did hit some resistance. No big deal, but look at the size of the move. You know, it did pull back. It held around 36, bounced off there. You want to take a closer up look here. You will see that if it can get above this, I would say, you know, 38.50, 39, you're going to see a move and a pop into the 40s. So I think as an investment, it looks good. And then I think traders would put it on their radar for a break above that level.
Sure, and then I also like the longer term chart too, because it gives me more confidence that if we're right in the theme, in the secular growth story, that it can actually move higher over time.
Well, there you go. A lot of bang for the buck in both time frames, and that's where we look at different time frame analysis. Now, what are your thoughts on JCI?
So JCI, you know, I liked this story because it was auto parts. Again, we like the auto parts industry. They have a leading position in batteries, lithium-ion batteries. They have a great presence in China. The problem with this company is they've got about 35% of their exposure is tied to Europe, and that's really been hurting their margins. And I just think that they've got a lot on their plate right now. If you want auto parts, there are better pure plays like a Dana. If you want the autos, there's probably a better idea in GM, the kind of the OEM. So this is one that if it got to 35, 36, this is one we would be paring back.
Okay, well, I look at the chart right now, and it looks a little different. At this point, it's trying to hold, if you go to the chart, this uptrend, okay? And as you can see, it's actually one of the few at the longer-term uptrend, so it's showing relative weakness. It's also below the moving averages, and I never like to see a stock try and break out and come right back down. So to me, if this thing can't get above this 33.90, you know, in the future, especially considering the rally this market's had, it could be a potential short below this area. So at this point, as a trade, I would say be careful, because once it breaks this area, you could see a trend change, and then you'll have to look a little further down to see what levels might hold. So for this one, as a trader, I would stay away, and it would almost be a short-term short candidate. Which, that's why there's two markets.
That's right. Well, that's why we would try and sell it into straight.
There you go, and manage it. And I think the last one we'll talk about was HOT, H-O-T.
Yeah, you know, this is a great company. This is, if you want China, this is it. They got 80% of their pipeline is in China, right, in all their properties. And it really is a play on the luxury market in terms of lodging. Absolutely fabulous management, great balance sheet, doing all the right things in terms of buying back stock, buybacks, et cetera. But I'm worried about oil prices. I mean, this is something that I don't think it'll hit the high-end consumer as much, but I do worry about it, and we've had a nice gain in it, so we're thinking about paring some of that back.
Okay, so if you take a quick look at the chart, I would say if you're looking to pare some back, if it, at this point, it actually seems as if it can get above 56, you might be able to sell it into the previous highs. I would say if you wanted to use a stop to pare back, you know, if it were to break this little channel, then maybe you get some downside action. It's within the moving averages, so it's not showing relative strength or real weakness. It's kind of neutral. So I'd say a break above this, you could probably sell it into strength. A break below that, you might want to pare it back right there. So right now we're going to take a quick commercial break, and then we're going to come back in the trenches with the casino stocks. So make sure to stay involved and tune in.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Welcome back. We're going to go into the trenches in the casino group, a group that I love to trade, that trades together. And your partner, Jim Cramer, actually, went over the charts last night and off the charts on his Mad Money. So he spoke about the alpha dog, about the leader of the group, which has changed over the course of the past few years, because I would say last year Wynn was the one that led the group, and recently it's been LVS. Now LVS fundamentally, Macau, Singapore, a little bit of a housing recovery, has a little bit of everything in there. And yesterday, the Macau numbers came out, which gave it a little bit of a catalyst. So if you look at the chart here, you will see that with LVS, short term, this was a nice little buy area when it crossed this descending trend line, okay, around 44. Then it broke above these recent highs, which was around earnings time. Then yesterday, it extended nicely. You might think it's overbought short term, but if you look at this monthly chart, which is a reason why I was bullish long term, this was your big move off the low. And look at this multi-month consolidation. Okay, it hasn't even pulled in. That means it's showing you demand, it's showing you new buyers, new institutions, so it's starting to break out. I do think this stock can get to about 65, 70, and at that point, I think as an investor, maybe you take some off, but obviously as a trader, we're going to manage it along the way.
Yeah, and I think you could take a couple different approaches to the casinos. Either you buy one like a LVS, it has high beta, right? And so if you have the stomach to deal with it, that's great. But I think if you can kind of buy a basket in a way, right? I mean, you can buy the LVS, the Wynn, the MGM. We were talking about MGM being our favorite or my favorite, and you said that it looked okay on the charts.
Yeah.
But I kind of like a little bit of a combination of all of them. So you get the beta, but you also get the play, which is that the environment and the macro is actually getting better.
And it also goes to what you can handle and what's your time frame and what type of stock you want to trade in. MGM, we love it sometimes, we hate it sometimes. If you look back, it finally got a little bit better when the economy started to have better signals, and this was when it broke above this $10. And ever since then, you've had a nice steady uptrend here. Okay, it did break it right there. That's why we say when uptrends change, you take some off. This was your first clue to take a little bit off. You then had a mini reversal yesterday. So I would say as an aggressive investor, you could buy it versus this little reversal here, because you could have a stop now at like whatever. Look for my eyes, I put this really big. So if you look there, you will see 1340 was yesterday's low. So if you want to be in and you think this was the dip, you buy a little bit versus that low. But I do think that it could try and go a little bit lower to maybe 13, and then major supports around 1230. So everyone wants a dip. But if we don't get that dip, you have to chase. So maybe be in a tier one and then wait for either momentum or wait for that bigger dip, in order to get more involved. Now, as far as the headlines with Wynn, what do you think as far as that big shareholder lawsuit, or do you not look too much into it?
Well, I mean, I think it was certainly concerning at the time, and I think that, it was certainly held the stock back. But, I try and think a little bit more longer term, and what is the positioning of this company? And I actually think that their position is great. I mean, look, the barriers to entry to Macau are huge, right? And they've got one, right? They're in there, right? And so is LVS. And so LVS might be cleaner at this point, but I think your opportunity is probably Wynn.
Yeah, and there's a trade there.
Yeah.
And I think you went over the trade yesterday. So, if you manage positions and you sold looking at the bearish technical pattern, you have the luxury of buying back. So if you take a quick look at the chart, if you saw this outside day, look how blaring this was. This was a huge outside day where it opened up and reversed. Okay, that gave you a sign that you better sell some. And then when it couldn't take back more than half of it, that was another signal. So you had a sharp decline, and if you didn't get out there, look at this one. You had another 2-day sharp move, lower high. So that was your second area to get out. And since then, look at this trend to the downside. So finally, they got what seems to be this shareholder lawsuit out of the way, or some of the news out of the way. So you have a small descending channel right here. I would say if it could start getting above this 119 to 121 and clears this area, you could have a nice trade here. So this is on my radar. I'm not in there yet. If it starts to break this little trend, I do think you could have freedom to about this 30 area, which would bring you back to old resistance. So as an investor, if you sold it correctly, this is an area to be, to reinvest. If you were shorted, I think at this point you should be covering because you made a decent amount of money there. And if you're looking for opportunity, watch that small downtrend because I think there's a trigger. Now, there's another stock that came out, which you have to know your time frame as well. It's the new issue, CZR.
Well, I mean, you can. It came out hot. It was a much smaller. They lowered the size of the deal, so and the float was ridiculously low. But the bottom line is that this is a play on the themes that we're talking about, right? I don't know if it's nearly as good a quality in terms of the assets that they have relative to MGM, for example, or even LVS and Wynn, but it certainly people are playing the float game. I think at this, and that's really why it popped.
That's exactly what I wanted to get into, the float game. There's the art of trading the first day of a new issue, and I talk about it so often. And that day, there was a lot of money to be made when it, had its opening print, it hovered, and then went above that 14 and went to 17. But as far as an investment, it has to prove itself. It needs institutions to get in there. You need a range to play against. And if you look what it's done since, this shows you that you just don't jump in. Look at this huge up day. This was huge. Went up to $18. There was a nice trade here around 13, 14, but that was then, this is now. And it's been trickling lower.
Yeah, because the quality of the company is not nearly what, it was priced at, right?
It could be, and it just could be, the selling group, the flippers, everyone in there, and it needs time to prove. I see a lot of this happen. Yeah. Didn't happen with Coors. Coors has been an unbelievable IPO, but it just shows you difference. But now there's two strategies you could use here. If you look back at the chart, you will see, right now it turned up a little bit yesterday above, at that $10 area. So if you wanted to buy small, I'm saying very small, at least you know your stop. Here's your stop here. I'll put this up here so you can see it. This is the low of that day. This is where it was priced around 9. So you have about a $2 risk, and this could be, the low end of the range. If you're waiting for a trade, look at this downtrend. Okay, some of these things break their downtrend, and that's typically when you can get involved. So if it were to start getting above, just say 12, perhaps you have a nice little trade back to 13, 14, and then you want to see if it goes up, and then obviously, makes a higher low, and then, starts a whole new trend. But I'm not going to draw a chart that hasn't happened yet. But here is maybe trade number one, and then this is, another entry. But typically with IPOs, depending on the speed and the flow, I say you have to give at least 6 weeks, but I think it's even more prudent to give it 4 to 6 months. So if you're looking for an entry for the long term, I would just wait a little bit longer there. And now, at this point, got to throw me some quick hits.
We're going to do some quick hits. Okay, and they're going to be quick.
Quick.
Okay, let's start with Apple.
All right, Apple, been a great trade since earnings. Got to show you the chart real quickly. 2 different time frames here. You go to this daily chart. I want to get this out of the way. If you remember, this was the gap up on earnings, and then this was your entry. And then since then, when it broke out, every sell has been a bad sell. It's at new highs here. I know guys are trying to fade it. It's up above 540. As an investor, I still think you hold it. As a trader, if it puts a 30-minute high in and you want to try for that cute short, which has made me ugly a few times, at least you'll have a plan. Just don't cost average it up, because that's how you get put out of business.
There's just no other better product cycle story out there, really. None. And the valuation actually is still very cheap.
Yeah, don't let the price fool you, because the valuation is still low compared to the growth.
Okay, let's talk about gold, GLD. Obviously, it actually had a good day yesterday. Gold had a good day yesterday, and I think a lot of people are thinking, is it the reflation trade? So what do you think from a chart basis?
Chart basis, it's acting really well. Just take a quick look here. Ever since the day the Fed came out and said they're going to keep rates low once again, you look down here, this is when it ignited, and now it's flagging again. I say above this area of 174, you can get a quick trade to 176, 177.
Cool. Okay. How about Google? Google actually, recovered from the really big move that it had a couple weeks ago.
Well, that just shows you again time frame.
Yeah.
If you're going to hold stocks through earnings, and that's your long-term thesis, you have to accumulate at certain points. And if you look here at Google, you will see that you could have bought here. I talked about this versus point. At this time, this was a 200-day. As a trade, you could have bought it when it went to fill the gap above 591, and now it's going sideways, consolidating. I did buy Google yesterday, and I think if it gets above today's high, you could see a move to 525 really quick. So I think it's back in its trend. It looks okay. As an investor, you probably have a better cost average now if you did it correctly. And at this point, I do think you could see a little bit more upside.
I do too. I just think that Apple's cheaper. So let's talk about IBM. That has just been, an amazing story, amazing stock, and just a quality company that you want to own in this kind of environment.
IBM last week, we had a nice breakout. I was holding it around 193. I bought more through 195. I sold some above 198. Still there. I might add for a cash flow if we can get above 199.29. That was the high from last week. Gets above there, maybe it'll knock on the door above 200.
And finally, MasterCard. People just love it, and it's a great story, but it's at a heck of a move.
Yeah, and MasterCard, I'd say it's hard to enter here. If you look at the chart, there are places to enter.
Goodness.
This is when it went above 405, and now it's extended. I would actually say, what does Jim say? Ring the register there. Short term, you gotta sell some there. And if you're a long-term investor, I guess stay the course, because just like Apple, every sale has been a bad sale until it's not.
And we're of the mindset we'd rather buy American Express. It hasn't moved as much, but we think it will hopefully
one day
hopefully go like that.
Yeah, it's nice, slow, and methodical.
Yes.
I looked at American Express. That chart looks pretty good as well. It's just not as quick as a MasterCard and a Visa, but again, it's all based on your time frame and how you want things to move. Great. So with all that said, I think it's important to see how we maneuver forward. Dow 13,000, S&P 1370. It's all well and good. Hopefully it breeds confidence. Maybe people out there think they're missing something. You never want to chase excitement, but I don't even think the market's that overbought. It is, obviously, if you look at the charts, but I would say short term, you stick with the trend as long as we stay above the 10-day moving average. And if we break that 10-day moving average and we correct, don't get scared. Get ready to look to buy and manage your positions.
Make a shopping list.
There you go, just like you have with your active portfolio.
Absolutely.
Okay, for more, if you want, during the day, you could listen to me on the radio. You could go to the virtual trade floor, and make sure to tune into Recap. We'll talk about what worked and what didn't. Have a great day trading.